Nexgen Software's T3 Market Flow will give you visual confirmation when making trading decisions. The following video will cover the best case uses for the volume analysis when used in conjunction with Nexgen's trading plan rules. You will only want to watch the market flow when you are taking a trade, at a termination area, at a potential management area or condition, and when looking to place an entry at the top or bottom. Each market flow bar contains several components. You will notice green and magenta dots inside the bars. These represent a disproportionate number of buyers versus sellers at that single price. Each bar will have two black lines that run horizontally through the bar. This represents the high volume area, representing the greatest number of contracts traded on each bar. High volume lines, used in one of our trading setups, will extend horizontally from the high volume area of a white paint bar. The white paint bar has two uses. First, when a white paint bar is followed by an immediate reversal, a bar in the opposite direction, the software will plot an arrow. This signal is used as an entry when all the trading plan rules are true. The second use of the white paint bar HVA line is when taking the HVA trade. Remember, this trade is only taken after the market has made a top or bottom termination condition. You will also notice the HVA lines will act as support, or in this case resistance. This will be especially useful when looking to pinpoint trend trade entries on the 5-1 chart or deciding to remain in a trade for a large profit. You will want to be careful not to place your trailing stops on the wrong side of an HVA line. The next pattern is called an antenna bar. The key to this bar pattern is the high volume area, denoted by the two black lines, is not touching the body of the bar. This next example shows you a yellow antenna bar formation. Notice it is at Fibonacci support and the large trigger lines. When you use an antenna bar as an entry, you will enter immediately. If you attempt to gain a better entry, you may miss the trade. The market tends to move quickly following an antenna bar pattern from a high probability setup. The yellow bar pattern shows a reversal in volume. The requirement for the yellow bar is multiple magenta or green dots on the high or low bar. That bar is then followed by a reversal bar in the opposite direction. That bar must contain at least one dot going the other way. Yellow reversals may be used as an entry signal when the trading plan rules are true. The next pattern is called stranded buyers or stranded sellers. There are several keys to this pattern. The first is the magenta or green dots must be located on the opposite side of the high volume area as the bar makes a reversal. The second is that the bar prior must be up or down, causing the stranded dots to be a reversal. Third, when this pattern is true and the bar itself is also an antenna pattern, the market is likely to reverse when price is at a termination area. At key areas, you will notice when the market flow has multiple signals in a row or single bars that are multiple signals at the time or same bar, the expected outcome can be easily predicted. Notice the yellow bar followed by a white paint bar from the Fibonacci low. This is an enormously powerful addition to a termination area. Usually, this pattern will generate your HVA long trade. Subsequently, trend trades that have HVA lines, or yellow-white or white-yellow combinations will also provide noticeably clear, powerful entry opportunities. A word of caution. When learning the market flow, new traders will try to figure out every signal, bar, dot, color, and pattern without first relying on the Nexgen trading patterns using the dynamic Renko bar structure. This will be extremely detrimental to your education process. Remember to only focus on the market flow at termination conditions or during a trade setup as dictated by the Nexgen trading plan. Please heed this warning and only use the market flow chart when it is absolutely warranted by the plan. Now we can move on to when you should and should not need the market flow as dictated by the plan. The entry criteria in trend trade rules says, check for divergence. If true, wait for a market flow signal before entering a position. While this may sound counterintuitive, we are going to teach you to use the market flow entries by first teaching you when you should absolutely not need the market flow for entry. The best trades that have the absolute best winning percentages will always have perfect looks in Fibonacci and trigger lines prior to the entry itself. Although the rule states if divergence is true prior to entry, wait for a market flow signal. In this case, you will be sacrificing some of your profit potential for a confirmation signal that will almost be guaranteed to be true. The key when deciding to skip a market flow signal will be found in the trigger line strength and location. When every trigger line on every chart is strong and the areas are extremely well defined and compact, you will find that your results will be much better when you enter at the spot, skipping the wait for a market flow signal. In this next example, when looking at the trigger line strength and location, the probability of continuation to the upside is extremely high. Well-defined entry areas will provide you a very simple and high probability trade. Now we will look at a market flow chart along with the 5-1 chart. When you look at the market flow chart during a strong trend, remember to focus mainly on the small versus large trigger line location. The stronger the range chart triggers are, the higher the 5-1 trend trade probability of continuation to a target is. This slide will build upon the prior lessons. First, when analyzing your charts, it is important to recognize the strong trigger line condition on all 3 charts. When all 6 triggers are extraordinarily strong, you will not need the market flow, and it should be ignored. The only 2 focal points for a trader should be the entry location of the trend trade on the 5-1 chart. Typically, when learning trend trades, novice traders tend to be nervous and full of adrenaline. This causes them to seek out any reason to take a quick profit or exit a position. Learning when to be confident entering or holding a position, based on the extraordinarily strong trigger line configurations, will apply not only at entries, but when you are holding for larger profits and ignoring market flow. The long-winded, super important lesson here is that new trades must avoid the pitfall of staring at market flow when they in a trade setup that has little or no chance of reversing against them. Instead, be focused on the target. Specifically, do not focus on or exit a winning trade with low probability exit signals generated by the market flow. Finally, we will look at conditions that you should wait for a market flow signal before entering a position. During extended trends, when the market makes a pullback to a trend trade entry area such as the mid-band and large triggers and divergence is present on the low, the rule that states waiting for a market flow signal should be applied here. Next, when there is divergence on the low, and that low is not much lower than a previous low, you should wait for a market flow signal when price reaches the trend trade area. This slide also depicts another scenario that you should wait for a market flow signal. When the area to go short could be 1 Fibonacci resistance or the one slightly higher, this is also a good time to wait for market flow confirmation before entering a position. The following example of a potential trend trade has 3 especially important indicator reading patterns that will demand a market flow signal prior to entry. First, there is divergence on the low of the 5-1 chart. Second, the fact that this divergence low pivot is higher than the previous low pivot is a warning that the market may be starting to reverse trend. Finally, the small trigger line location is inside of, not below the large triggers. This is known as a weakening of the triggers, combined with the other 2 reasons, makes an extraordinarily strong case for waiting for confirmation. As you can see, this pattern caused a reversal in the market and the market eventually traded higher. This is a quite common pattern when the market overruns a key Fibonacci area on the larger 13-2 chart, only to reverse position quickly. Typically, in the case of an overrun and reversal, you may use the market flow to trade long from Fibonacci support if there is an appropriate signal. The market flow is essential when doing HVA trades after a termination condition. Remember, the white paint bar will generate a green or magenta line from the high volume area. This will be the entry for the trade. It is also extremely important that prior to looking for an HVA long or short, you are 100% certain that the market has made a termination condition from a key Fibonacci area, a pivot stop out, or termination conditions on multiple charts. In this example, notice the multiple Fibonacci supports, with weak triggers above the Fibonacci low on the 13-2 chart. This is a termination condition. At the same low, the market flow had a reversal arrow caused by a white bar down and reversal bar up. This bar was also an antenna bar that included stranded sellers, represented by the magenta dot below the HVA area. This is 3 signals in one bar. This, followed by a white paint bar up, this adds an enormous amount of confidence that the low is in. When you are new to the Nexgen education chat room, you will see many of our most experienced users take this long signal from the low. Recognizing it is the first step in trading it. For new users, the easier trade comes when the market makes a retracement to the green HVA line. The limit order to enter is placed just above the green HVA line. The entry is filled as the market reaches the green line. The next bar up is another market flow long signal. This is a quite common occurrence when the market flow signals from the termination condition at the edges was so strong. To circumvent future mistakes caused by the prior slide and lesson, I must spend another minute discussing trigger lines. Similar market flow patterns that created long trades at Fibonacci support in the last slide happen on this chart. Notice the multiple stranded buyer green dots above the antenna HVA bar at Fibonacci resistance. This is where the big sign says do not enter. New Nexgen traders make the mistake of trading against strong triggers. If you remember from prior lessons in this video, we talked about how the market will normally go higher when the triggers are strong. This will be the reason you cannot trade short at Fibonacci. While the market did go down a bit, any shorts would be deemed exceptionally low probability. Notice the chart also made new highs one more time. Once the small trigger lines were below the large triggers, and more importantly all the triggers were below Fibonacci resistance, high probability HVA short trades at Fibonacci resistance would have been extremely successful. To repeat the lesson, it is very important to never trade against strong triggers and only focus on trades that have both Fibonacci and trigger lines in agreement. Now that you have a clear understanding of the HVA trade, you will work to gain confidence in the trading rules by studying historical HVA trades, using market replay and focusing only on those trades that meet all the rules. In this example, you can see the 13-2 chart had a pivot stop out at Fibonacci support. More importantly, none of the trigger lines on the 13-2 chart were below the low of Fibonacci support when you were placing your trade to go long. When you learn to focus on the HVA areas for entry, you will quickly and confidently take trades from the HVA lines. In this final example, the termination condition at the top of the 13-2 chart was Fibonacci resistance that caused a reversal of the trend. The HVA short trade in this example was also a trend trade. Look on the 5-1 chart. When you have both an HVA and trend trade rules together at the same spot, you will end up with very high probability trades. Remembering that strong trigger lines generally yield larger moves, the profit potential on this short trade was exceptional. As you have already seen, the market flow signals combined with multiple chart termination conditions will create opportunities to trade from the edges of the market. Generally, new traders are encouraged to focus on those trades in which the probabilities are enhanced by multiple chart, strong trigger line looks. Most traders opt to start looking at edge trades only after they have built and traded a successful plan, trading real money before they start work on a trading from the edges plan. When trading from the edges, or non-traditional trend trades, or when trading termination conditions such as a pivot stop out on the 5-1 chart, waiting for a market flow signal for entry is best before taking an entry. This setup to go long has multiple market flow conditions that are greatly beneficial to the long trade. First, there is a high volume area green line of support. While not an official HVA trade, the HVA line will help support the market long position. The signal itself is a powerful multiple signal on the same bar entry. First, there is a reversal arrow caused by the white paint bar down and up reversal bar. That same bar is also a yellow volume reversal, giving the signal twice the power. If not already in a trade, you will want to enter the market immediately after the double signal. As we have already discussed many times, the trigger line width and separation after the entry continues to grow, signaling that the move may make it to farther Fibonacci targets. It is important that when you take a position in the market, you maximize the potential of every trade. Finally, for those traders who will take attempts to counter-trend trade the market flow will be an invaluable tool to give you the confidence to initiate a new position. Make sure that when counter-trend trades are taken, never, ever do so against strong trigger lines. It is also very important that there is very clear termination conditions present, preferably on multiple charts. In addition to termination conditions, the weaker the trigger lines, the higher the probability of the trade being successful. Finally, if you have a powerful market flow signal to time your entry, you will have the greatest chances of success. This market flow signal has a reversal arrow caused by a white paint bar up followed by the down bar. The down bar was also a strong volume reversal with 5 magenta dots in it. This picture was taken on Friday, April 16, 2021, just before the close of the market. At the time of this video, this slide shows the highest recorded E-mini S&P futures price ever recorded in the history of the market. Pretty cool example of this setup, if we say so ourselves. As you practice the Fibonacci and trigger line patterns and market flow entries, you will start to recognize setups like this one on many markets, many times per day. As you work to incorporate the market flow, you will have a robust trading plan that will take advantage of many market conditions to maximize your profit potential. Finally, the market flow will also help to give you an early warning that your trade may require management. Once you are comfortable with the market flow, you will recognize situations that the market flow will either support your holding a position or exiting a position. This is an example of a lesson that was given in our live trading class. The trader took a long trend trade position. The entry was perfectly executed at the mid-band. Eventually the trade ended up as a loss due to the fact that it was managed incorrectly. During the lesson in class, it was pointed out that when the 5-1 chart has divergence and the small triggers are down, and the background color turns red, the trade should have been exited. As you can also guess by now, the fact that the range chart small triggers were down, as well as a magenta HVA line resistance hurting the position, added to the probability that the market would reverse. The correct management would have been to exit with a small profit, and then look for another trade from the edges if possible. As you study the market flow, pay particular attention to weak triggers, divergences, and market flow signals that line up for fine-tuning your management. Also, keep in mind that it is very important that you participate in class, posting your losing trades and gaining a quick understanding of how to manage your entries and exits properly. Fibonacci and trigger line reading is the foundation of a great trading plan. Market flow will enhance any great trading plan. It is also of paramount importance when using the market flow for entry or exit timing. You are doing so when the rules from the plan are true. Please make sure that 99% of your analysis is focused on the large and small dynamic Renko charts. When you focus on your large charts and only use market flow when appropriate, you will have much more success with high probability trades. It bears repeating, never, ever take trades with the market flow that are against strong triggers. Finally, if you can participate in class, you will find the analysis of your trades an invaluable asset to speed you through the learning curve. Thank you for trusting Nexgen with your Fibonacci-based technical analysis.